Hello and welcome to this Autovista Group webinar. Today we're exploring Autovista Group's residual value outlooks for 2025. I'm Tom Geggus, the editor of Autovista 24, and I'm your moderator today. On our panel of experts is Dr Christof Engelskirchen, Chief Economist at Autovista Group, Dr Anne Lange, Director of Research and Innovation at Autovista Group, Robert Madas, Regional Head of Valuations in DACH and CEE regions for Autovista Group, and Anne Azofra, Regional Head of Valuations for Southwest Europe and Poland at Autovista Group. Thank you all so much for joining me today. So, what can you expect from this webinar? Well, first up, we're going to explore the state of Europe's used car market as it stands. Then we're going to come to explore what to expect from 2025. And then we're going to take a look through some market specifics. This will all be followed at the end of this webinar by a Q&A session with our expert panel. So if you have any questions for us, please do leave them in the comments box. We would love to hear from you and answer your questions. Now, of course, if we don't have time to get to your questions today, and sometimes it does happen, we will of course come back to you after the webinar in an email. So please don't fret if you don't hear from us in the webinar. So I think we can kick things off, Christof. I'm going to ask you to get us started. What trends have you seen define Europe's used car market as it currently stands, and how have we seen 3-year-old cars at 60,000 kilometers perform?
Yeah, hi Tom, hello everyone. So if we look at the main trends, that are affecting used car markets in 2024, I see those four that you can see on this page. And if we just want to rewind a little bit, because from the discussions I'm having, a lot of people are always comparing things with the pre-pandemic situation, right? So overall, we see that things are moving a little bit back to those pre-pandemic conditions, and we see that in the numbers. So first of all, we have a situation that in most markets the new car sales contracted in 2024. Not in all markets, but in the biggest ones they did. So France -3%, Germany contraction -1%. We do have Spain and Austria who have added volume. I'm happy that Robert and Anna are here and they can make a reference to that as well. But we see that we're a little bit struggling to sell cars in many markets in 2024 compared to the year before. We also see, and this is the second bullet on the slide, we also see that this volume isn't happening through the healthy channels. So private sales or sales to private individuals, sales to fleets has come down. This is an example for Germany here. And those channels, which are usually creating a little bit of pressure for used car markets, because these cars, return to the market quite quickly and are easy for OEMs to push volumes into the market, rental OEM and demo cars, they have been rising. So again, not positive for residual values. I want to point our attention also to another important KPI for us, I believe, and this is consumer confidence. So I'm not sure how familiar you are with the concept of consumer confidence index. If it pops up and you see 100, that's usually okay. So 100 means long-term average of consumer confidence. It's a reference point. So 100 is all right. If we are below 100, it means households have a tendency to save a little bit more and spend a little bit less. And we're talking about cars, used cars. They are expensive items for people to purchase. So they think maybe not twice about it, but now maybe 3 times. And for the Euro area and also for the UK, this CCI, this Consumer Confidence Index, is now at 99. It's, by the way, the same as 2023, so it hasn't gotten worse, but it's worse than how it was pre-pandemic at 101, which again wasn't great, but it was significantly better than it is today. Last bullet here. It's the smallest on the page, but it's probably one of the most important to watch out for, and that is we do have a situation of subdued economic growth across most European countries.
And have we actually seen an enormous amount of dynamic change since our last webinar in November, Christof?
Well, they haven't changed a lot because we are on that, trajectory towards pre-pandemic, market conditions. The economic outlook, and this is the one I just want to point our attention to just for a while, because this is really important, and it also hasn't changed since November, but it is, a challenge, for Europe, for many markets, and it affects new car markets as much as used car markets. And you can see here that the big European countries, they are at the bottom of that list when it comes to growth rates of gross domestic product. Yeah, and the only notable exception here is Spain, where we're seeing a bit better growth, a bit better recovery. But Germany, Italy, UK, France, they are really at the low end. And if you're following the news, there are a lot of talks about how good the situation is looking like in the United States, for example. But also in the United States, we only have 3% growth, and it's about 3 times as much growth as we're seeing in some of the bigger markets in Europe. So that is a bit of a concern, of course. But it hasn't changed since last November, Tom.
Sure. Thank you, Christof. And what about seeing these wider used car market trends reflected in prices? What's happened in our price index?
Absolutely. So let's move to the actual used car market performance that we are leading towards in this webinar. And don't be misled by this chart. What it means is that residual values have dropped significantly in 2024. What it doesn't mean is that residual values are below pre-pandemic levels. Yeah? We're still in a situation where cars sell at higher prices, used cars sell at higher prices than in 2019. We're going to see some more charts, I believe, throughout this webinar about this. So this is only 2024, and you can see that this pressure, that we're seeing on used car prices isn't going away. Yeah, so that trend is consistent. It's not bottoming out. Exception again, I keep referring back to Spain, which is the yellow line. This is like a darker yellow line here, where you can see it is kind of bottoming out, leveling out. And but the rest of the markets, there is a decline, and we're going to show you some outlooks later as well. And it doesn't look like this decline is going to be stopped in 2025. So basically expect 2025 to be a continuation of 2024 in many aspects.
Thank you, Christof. Now, Anna, I think there's been a fairly exceptional market that we've seen, and it is, of course, Spain. Maybe you could walk us through some of the major influencing factors behind the behaviour of Spain's used car market.
Of course, Tom. Actually, this is not the first time this has happened. Spain has always shown, let's say, distinct behavior from most European markets, at least among the big five. To help us put this data in perspective, in the chart on the top left, we have in black lines or bars the difference in percentage points of Spain versus the average of the other big four markets, which are represented by the blue line. And we can see that this difference has always been in favor of Spain. Only after the pandemic, when more global challenges demanded more global strategies, this gap narrowed to just 2 points. And now the gap is widening again because, as Christof just mentioned, residual values in Spain have shown greater stability. This doesn't mean residual values increase, but they drop less than average. You also see the figures in the table on the top right. And in addition to a more positive economic context, this better performance can be explained for a few reasons. And the first one is the lack of middle-aged stock. It's true that new car sales have performed well in 2024. However, this hasn't been the case in recent years. The recovery has been slower in Spain, with fewer vehicles flowing back into the used car market. The second reason is the famous slow adoption of BEVs. As you can see in the chart on the bottom left, Spain is the yellow line, and again in comparison to the big four. This slow take-up means that only 2% of the current used car offer is made up of BEVs, while in the major markets already account for 10%. And as we all know, BEVs have the worst performance in terms of residual value in 2024, so the impact is less pronounced in Spain. And that said, and this is why we refer to this situation as a mixed reality, is essential to clarify that Spain's advantage in residual values, when expressed as a percentage, does not translate into an advantage when absolute figures. In fact, Spain lags the Euro 5 average by 1% in this regard. And very important, as shown in the final small chart, list prices in Spain are 14% below the average, what means more than 5,000 euros difference, benefiting, of course, residual values in percentage. And if we move to the next slide, as we can see from the chart on the left, this advantage dissipates when we analyze younger used vehicles evolution. There was a significant drop in the average residual values for young cars during 2024, mainly contributed by the stock pressure, growing by 30% over the past year, and coming from the increase of the rental car channel, which feeds younger vehicles into the used car market, also higher imports, big part of them PHVs, greater pressure from BEV sales. Nevertheless, this beginning of 2025, as you can also see in the chart, is releasing some pressure on the transaction prices of these young cars. Then, in summary, better performance, yes. Greater stability, also yes. However, Spain's advantage disappears when considering absolute residual values and younger vehicle segments.
Thank you so much, Anna. Now I'm curious as to see how weaker registration years have impacted RVs. Robert, maybe it's time for you to tell us what's going on in Austria.
For sure, Tom. But let me start with a more European perspective to put the supply situation into context here. On the top left, you can see the evolution of new car registrations across Europe in total. And as mentioned before, in the years 2019 and before, we were used to really high volumes, in total around 18 million, with a steep decline in the following years, 2020 to 22 mainly. And if you sum up those missing vehicles that were not newly registered in those years, you have a total amount of more than 13.5 million vehicles that are today missing on Europe's used car markets. Even with the slight upwards trend in the 2 recent years, today's volumes are still well below 2019. So today we see the situation that the supply of 3 to 4 year old used cars is significantly below the levels that we have seen before the pandemic. On the bottom left of this chart, you can see the trend of the supply volume for 2 to 4 year old cars in Austria. So now here is an example from Austria, but the dynamics are similar also in other countries. You can see that today's supply is significantly lower by approximately 30% than in the beginning of 2020. So in this situation means that for RVs, we have a stabilizing factor because the supply is not on the same level that we were used to in 2019. So without this supply shortage, there would be even more pressure on RVs than what we see today.
Thank you so much, Robert. Well, I think that's everyone caught up with the current market situation, which brings us to the second stage of our webinar today, what to expect in 2025. Well, we'll take a look at some market specifics after that, and then that'll be followed up by Q&A with a chance for you to ask our panel of experts some questions. So again, please do let us know your thoughts or comments in the questions box. Anna, Azofra, I'm going to come straight back to you if I can. Maybe you could take us through the outlook for the coming year.
Yes, sure. Okay, let me begin with this chart, recently published in Autovista 24 as part of our monthly market update. And because I believe it provides a clear picture on how 2024 was a year of negative adjustments across all European markets. And in previous years, used car prices experienced significant inflation, primarily due to stock shortage, we also mentioned during the webinar. However, since 2023, prices have started to readjust as the balance between supply and demand has improved. But it's important to remind, and Christoph also did it, that on average, we are still above pre-pandemic transaction prices. And we see all these movements as part of a market normalization process, something that was both expected and necessary. As we are hearing these days in the news, when they talk about significant falls in the stock exchanges, prices rise by the stairs but fall through the window. And in our case, it's usually the opposite. Prices inflated fast, but the adjustment is taking place gradually. Now, what can we expect for 2025 and the years ahead? And as we can see in the next slide, we anticipate this trend to continue with an average decline of 2.5%. And you can see the different levels of adjustments in the heat map on the left. The darker colors correspond to the higher negative forecast. And we see all markets in negative, ranging from a modest 0.7% decline in countries like Sweden and the Netherlands to declines nearing 4% in neighboring markets such as Belgium or Norway. Also on the right of this chart, you can also see the outlook for almost all the countries where we operate, grouped according to the expected impact. And several factors will influence residual values and explain this negative outlook. On the one hand, the depreciation of BEVs and of course the impact of CAFE regulation, and Robert will discuss in detail in a few minutes. On the other hand, the macroeconomic conditions and price pressure from new competitors will also play a role. Looking further ahead, the outlook becomes more optimistic. The adjustment appears to reach completion in the following years. By 2026, the negative trend is expected to ease, and by 2027, it will improve significantly. And even some countries such as Sweden, Finland, and Netherlands are even projecting positive figures by that time.
Wonderful, thank you so much. Now perhaps we can drill a bit deeper into some different powertrain performances. Robert, which region's forecast really stood out to you when it comes to battery electric vehicles or BEVs, and why?
Let me start with the bottom left of on this slide, the bottom left chart, which shows the RV development of BEVs in the different European countries. And as you can see on the bottom left chart, BEVs had a hard time last year in terms of having stable or not stable, actually negative RVs for 3-year-old cars. There were some regional differences. You can see the green line. Italy had a steeper decline. Also France was affected a bit stronger, but also Central European markets like Switzerland, Austria, or Germany were affected. Only Spain, as we have heard, but also the UK had a slightly more stable trend. But summarized, the trend was negative in all markets. And in 25, we expect some more adjustments. This can be seen on the market outlook on the top left of the chart. That through all over Europe, in every single country that we analyze here, we expect a negative trend also in this year and also in 26, but not with such big adjustments in 26. The reasons for this are, on the one hand, the CO2 targets that Anna already mentioned. So OEMs are under pressure to hit those targets in order not to be penalized. And this leads to discounting on the new car market. We can observe this already on some markets. And this, of course, is putting pressure on RVs. And then another interesting effect comes from the supply side. Generally, we have talked about the supply being quite low compared to previous years, but for BEVs, the supply actually increased in recent years as used BEVs are hitting the used car markets, those that were registered in 2021 and 22. Those were the years with high growth rates of BEV market share. And this increased BEV supply meets used car markets with weak demand. And for BEVs, there is a quite weak demand due also to technological reasons that we will explore a bit in more detail also later. So yeah, generally speaking, BEVs will remain under pressure with some regional differences, but we can see a negative trend all over Europe also in 25.
So more pressure for BEVs then. But how do these results stack up against internal combustion engine powered cars, for example?
That's an interesting question, because here we see some differences. So generally, we can state that ICE models outperform BEVs when it comes to RVs, specifically for 3-year-old cars and older. On the top left of this chart, you can see an example from Germany with used car actual trade values for 3-year-old used cars. The yellow line being hybrids, blue line petrol, red line diesel, light green is plug-in hybrids, and green line are the pure electric vehicles. What you can see right away is that the trend for petrol and diesel cars is a bit more stable. It's still a slightly negative trend. We have explored this earlier in this webinar, but it's more stable than the steeper decrease for electric vehicles. And what you can also see at the first glance is that the spread is quite big. So the gap between the best performing powertrain and the worst performing powertrain is quite big. On the bottom left side, you can see that on average, a hybrid would have 52%, around 52% residual value, electric vehicle 38% residual value. So quite a big gap. Now, if we now look on the other side, on the right-hand side of the chart, here we have an example for 12-month-old used vehicles. And here RVs show quite a different pattern. The best performing powertrains and electric vehicles, they are quite close to each other in percentage terms, between 56% to 60%. So here the gap is not that big. And also the trend, you can see moving to the right, the 3 months, 6 months and 12 months trend is more stable for young used vehicles, as opposed to the 3-year-old cars, where you can see the red arrow showing that there is quite a steep negative trend for electric vehicles in the past 12 months. So again, summarizing, ICE models generally perform better when it comes to RVs for 3-year-old vehicles or even older vehicles.
Wonderful, thank you, Robert. So we have a good idea of where the market is likely to head and residual values with it. Anne Lange, maybe you could walk us through the key indicators that's going to help us track the market's performance and compare them to our forecast.
Yes, Tom, sure. So maybe firstly, sort of why it makes sense to look at these. So I brought with me some market indicators also for Germany, because Robert's just been talking about it. So the data that we're seeing here is basically market observations, so vehicles sold by dealerships into the market. And to sort of make sense of what is happening in the market, what is happening with residual values, and also use it as an early warning sign for future developments in the market. It definitely makes sense to look into these. So what we're seeing here is the development over the last 3 years for the average car age of different fuel types, the average stock days, so the days it takes them to sell, and the amount of price changes that needed to be made by the dealership in order to get the vehicle sold into the market. So what we can see, for example, with the car age at the top is we see the diesel line in red and the petrol line in blue and the battery electric vehicles in green. And we can see that the average car age is rising over time. And that goes very much in line with what Anna and Robert have been saying about supply shortage and there not being very many young cars coming into the markets over the last years. So that sort of explains that or gives some context around that as well. But what we also see is that the battery electric vehicles on average are much younger, which again is in line with what Robert and Anna have been saying about the supply push of battery electric vehicles into the market. So the car age basically gives a bit of a flavor of what is coming into the market, what is going out of the market, to understand sort of the structure of the market in terms of age. And then if we're looking at stock days in the middle section, as you can see, that line is a bit more volatile because it's sort of immediately reacting to the markets. Basically, what is happening with the offer and with the car park is reflected in the stock days. You can see here, for example, the battery electric vehicles compared to the combustion engines. They in 2022, they were selling quite rapidly because we didn't have very many battery electric vehicles, so there wasn't lots of supply. And then over the last 2 years, the stock days were rising, which is because of the push of battery electric vehicles into the market. So it's basically given a bit of an indication of the market saturation, which vehicles are more in demand and which vehicles are less in demand, and also an indicator for pricing. Whether vehicles are underpriced or overpriced, because obviously overpriced vehicles will take longer to sell. Which brings me to the last indicator that I wanted to share today, which is the price change count. So basically, how often does a price need to be adjusted, which mainly means discounted for a vehicle to be sold. And what we can see here again is that there was quite a lot of price adjustment for battery electric vehicles over the last 2 years, meaning that it's very much more difficult for battery electric vehicles to be sold into the market compared to combustion engines. And if you combine the stock days and the price changes, you can see that there's quite a lot of work to be done to get these turned over into the used car market.
Wonderful, thank you, Anna. It's great to see that breakdown of the KPIs for the market. So now we know how values are expected to perform, the various KPIs. I think it's time we take a look through some market specifics. But just before we do, please don't forget to submit your questions for our Outlook panel. Just head over to the comments box and leave us a question. Now, Anna Azofra, we've spoken about BEVs already quite a lot today, but it continues to be a rapidly advancing powertrain, with each generation taking strides past the past predecessor in terms of what it can achieve technologically and its range. And this is obviously putting pressure on the RVs of older models. So how do we differentiate the forecast between older BEVs and newer BEVs?
Mm-hmm. Yeah, okay, Tom. Then let's start revisiting all the factors considered when we are calculating the forecast value of an electric vehicle. First, we analyze a specific product characteristics. The most important ones are technological, starting, of course, with range, followed by charging speed, battery efficiency, including durability, and also in-vehicle technologies like the software, ADAS, connectivity, over-the-air updates. And when it comes to all these aspects, the improvements in the 2024 EVs generation are, I guess, evident and don't require further explanation. Then price positioning also plays a crucial role in valuing an EV. And here we have moved from a market dominated by very expensive EVs in the past to one where prices are beginning to align with internal combustion vehicles, including also more affordable options. Design is another critical factor. In the past, EVs were either overly basic in terms of design, or very futuristic, and this caused them to age quickly, impacting, of course, residual values. And current designs are less polarizing, with a consequent positive impact on RVs. And last, when evaluating a vehicle, we also have to consider external factors, such as purchase incentives, charging infrastructure in the country, competitive scenario, and always important, the balance between supply and demand. An example of this can be seen on the next slide, where we present a comparison between 3 different EVs generations from the same manufacturer and between similar segments. And here we observe that improvements in battery technology, range, efficiency, charging speed, and equipment are significant from one generation to another. However, these improvements had a much greater RV impact between the first and the second generation of EVs. Now the residual value differential is, let's say, no longer proportional to these improvements, as it is mitigated by increased supply. But on the other hand, it's also worth to highlight the positive impact of the ratio between list price and EV range, which is translated into a positive effect on the TCO, or total cost of ownership.
Thanks, Anna. Now, Robert, maybe we can talk about segments. How are small cars performing?
That's indeed an interesting question, especially because on the current new car market, there are less and less small cars on offer. That's simply because for many OEMs, it's not so profitable anymore to offer a large portfolio of small cars. And also we see that the new prices of smaller segment cars, they have increased above average in recent years. So this drives demand to the used markets, and it leads to high offer prices and consequently also to high RVs. And that's exactly what we can see on this chart now. We see the German price index development broken down by segment. But starting from February 2020, so it's more a longer term view here, the different segments are indicated in different colors, with A segment cars being the dark blue line and B segment cars the light blue line. With the supply crisis and the pandemic years, we see that in the beginning, the development of the price index was quite similar for all the segments. So we had these skyrocketing prices during 21 and the beginning of the year 22. But then, as you can see, in the following years, the price index remained exceptionally high for A segment cars and B segment cars. A segment cars today with roughly 30% above the level of 2020, and B segment cars roughly 18% above the level from the beginning of 2020. So there is a high level on the used market when it comes to the offer price, and this is also visible in RVs. And that's, I think, a quite interesting development in recent years with the markets that have begun to stabilize, but A and B segment cars showing quite exceptional development here.
Thank you, Robert. Now, finally, Christof, in this segment. Last year, there was a great deal of talk about new brands entering Europe from China. And we did, of course, hold a webinar on the impact of tariffs in early November, which our audience can find on Autovista 24. And I want to know what you think could happen to the RVs of hybrids in Europe, as many Chinese car makers might consider pivoting to that powertrain to avoid tariffs on BEVs.
Yes, it is true that with the tariffs, the Chinese OEMs are reconsidering that initial 100% BEV push that they were thinking about, right? So they are thinking about introducing more hybrids, and when I talk about hybrids, I mean plug-in hybrids with significant ranges. Yeah, basically because they can avoid the tariffs that way, and it's the logical consequence. Yeah. Now these cars, if you've seen them, if you've driven them, they are quite competitive. Yeah, so they have long ranges and they are affordable, and it is a viable transitional technology. And that's not a bad thing, right? So transitional technologies in this whole transition to electric vehicles play a huge role, and they will, be well received on used car markets, I believe. Now we will, of course, see an impact of that trend on the older, less competitive plug-in hybrids when this trend appears on used car markets. But we're talking here about, smaller volumes. We're talking here about also a time needed for Chinese OEMs to create that demand for their vehicles, and they also have to comply with the CO2 regulation that is in place. So talking about fleet targets getting much tougher this year, so they will also still have to find the balance between ICE and plug-in electric vehicles or ICE vehicles and the pure electric vehicles.
Thank you, Christof. Now that brings us to the Q&A section of our webinar today. Now, as ever, please do make sure you send in your questions to us so that we can get them answered either during the webinar or via email afterwards. Now, I would like to start off by asking, actually, because it's come up during this webinar, the idea that residual values are simply normalising post the COVID-19 inflation. But what I wondered is, will RVs stabilise after they return to pre-COVID-19 levels? Anna, I'm going to ask you first if I can.
Yes, sure. Yes, it's true that we are anticipating negative adjustments in all countries. Also, Anne explained very well the trends, the KPIs we are analyzing. In some cases, these adjustments will be lighter, below 1%, and in others, more intense, around 4%. And let me explain that I mean variation from an absolute RV. And the European average, all markets, will be around negative 2.5% this year. But in 2026, we expect these adjustments in all markets will be softer, reaching an average of negative 1.3%. And in 2027, we expect a greater stability with even growth in some countries. But I would like to insist that this evolution is more a normalization of the market rather than a fall.
And Robert, maybe I can get your view as well, please.
Yes, I agree with what Anna has said, and we even see today some evidence that RVs stabilize. As I've shown for petrol and diesel, in some markets, there is a stabilizing trend already as supply and demand come into more balance. So I think it's mainly dependent on this, obviously, supply and demand balance that is still off in some cases. We talked about BEVs in particular today, so there is still a problematic outlook or negative outlook. But in some segments and countries, we already see this balance coming back into the market. And then the answer would be yes, RVs will then be more stable and similar to what we have seen in the pre-COVID years.
Anne Lange, maybe you could just explain how that's going to be informed by the KPIs you were discussing earlier.
Yes, Tom. So I think, Robert and Anna and Christoph have alluded on sort of all the different factors that are coming into play when it comes to RVs. So we have the supply shortage from the post-pandemic years, and then we have the BEV push by European manufacturers, but also the Chinese manufacturers pushed into European markets. There's a lot of different factors at play, and obviously residual values are the key metric to look into how successful a vehicle is. But these indicators give, as I said earlier, a bit of an early warning sign and a bit more context around why certain developments are as they are. if stock days are rising or if the amount of price changes are rising, that is a sign that a vehicle is less desirable. And also, like if you take a residual value of say 60%, it does make a difference for the success of that vehicle if it's being sold quickly or if it's being sold slowly, or if there's a lot of price management that needs to happen. That is sort of an indication for how that vehicle will develop in the future.
Thank you, Anna. Christof, I'm going to take a bit of a left turn, but of course it's something that's taken over headlines, news headlines recently, and that is President Trump in the White House now. Can we see any of his policies, actions in the White House possibly affecting the European used car market?
I mean, the short answer is yes. We can. The impact will be, if it happens, more indirect. Yeah. Because his policies do not necessarily or not directly impact European used car markets. The way they could impact Europe's used car markets, though, is that if there is a trade war starting, between the US and Europe, it basically means that economies would be hurt. Yeah, and and there are forecasting institutes which project that if these tariff discussions and threats do not result in a deal, we know that the president also likes to strike a deal, with partners. So if that doesn't happen and it basically comes to more of a trade war type scenario, then this outlook that I showed in the beginning, so around 0% growth in Germany, according to some institutes, could be even half a point less, right? So, I mean, take half a point off some of these economic outlooks and think that through. I mean, that would be the worst case scenario. I'm not saying that it will happen, but it's definitely something to watch out for these forecasts.
I think we have time for just one last very quick question. Christof, I will stay with you if I can. Obviously, we've seen incentives for new BEV purchases be removed in a lot of European markets in 2024. Is this going to actually have a positive effect on the used car market as we'll see that price gap closed?
Yeah, so, and I think that Anna made a really good point on that. So the more recently launched battery electric vehicles, they are more competitively priced. They are more suitable for daily use, even for those who are a little bit anxious about this technology, but it'll still take some time. I'm a bit more, worried and concerned, but this is all reflected in our forecasts about car manufacturers needing to hit certain shares of registrations for these BEVs, creating an oversupply which used car markets in many instances are not ready to absorb because they are always a little bit lagging behind. But in this particular case, the industrial policy that is in place just doesn't support a higher adoption of used BEVs in the market, and this is what we're seeing happen. It's reflected in our forecasts.
Wonderful. Thank you so much, Christof, and thank you to everyone for your fantastic questions. I'm afraid that is all we have time for, but don't worry, we will get back to you in an email. So again, thank you all. Thank you to the panel today. You've been fantastic, and to the audience who've submitted so many great questions. If you do need to check out some of Autovista Group's products and services, please do. You can follow autovistagroup.com/explore. And don't forget to sign up to Autovista 24's email for analysis. You actually find a recording and a write-up from this event on Autovista 24. So thank you for the panel to joining me. And of course, don't forget to check out Autovista Group's next webinar, which is coming at the end of March, an EV Outlook. So make sure you sign up there and register to attend. Thank you all so much and have a fantastic day.
Thanks, everybody.
Thank you.